What's up everybody, Nate here. And for the first time in about 3 or 4 weeks, mortgage interest rates in the United States dropped. They went from around 7.2% down to around 6.6%. And that could not have been at a better time because the housing market is kind of struggling all throughout the country. We have seen some major banks and institutions like Zillow and Wells Fargo and Open Door lay off thousands of their workforce because they're just not bringing in enough business to keep them on. And around 85% of consumers believe that this is one of the worst times to buy a home in American history. Not only that, but general home buyer demand and mortgage applications have been dropping. The supply of homes is still extremely tight and low all throughout the country. And some firms are actually predicting that prices in the housing market are going to drop by 20% or more going into 2023. So with all of that being said, today I want to talk about what exactly is going on with the housing market, how all of this is going to shape up in 2023, and what we can expect to see next year. And to start, I want to talk about what exactly is going on with mortgage interest rates. Now, the 30-year average fixed mortgage interest rate dropped by around 60 points in one day, all because of inflation. Now, inflation in the US has been steadily going up, but numbers from the latest CPI report released just a few days ago actually show that inflation is starting to come down in our economy. It went down from around 8.2% to around 7.7% in 1 month. That is a pretty big decrease, and it's showing that the Federal Reserve and our economy and businesses are all kind of bringing inflation down in one way or another. But what it also could mean is that many Americans are not spending as much money as they were before. So we still have a lot of inflationary problems, but with inflation kind of coming down, that has meant a lot of different things for our economy. And your mortgage companies like banks and financial institutions are also starting to see the writing on the wall, and what they believe might be coming next is that the Federal Reserve is going to slow down its mortgage interest rate hikes. They've been raising their interest rates to kind of bring down demand in our economy, but with inflation coming down, that means they might slow down too, and that might also mean mortgage interest rates don't need to continue to go up at such a high level. Now, don't get me wrong, mortgage interest rates are still double what they were just a year ago. Considering we had 0% interest rates from the Federal Reserve for around 2 years, that has meant that interest rates were also around the 1 to 2 to maybe 3% mark for most Americans. So if you got a house over the last couple of years, you got a really strong interest rate. But people who are buying homes in 2022 now are getting an interest rate at 6% and 7% and maybe even 8%. That simply means that they're going to pay around $300 to $400 to maybe even $500 on average more for their mortgage, depending on the price of the home. So by no means is the housing market out of the woods just yet. And then you have to kind of look at everything else going on in the housing market right now. I kind of mentioned that home buyer demand has dropped to its lowest point in over 20 years. Not only that, but most Americans believe this is a terrible time to buy a house. What that means is many Americans are not buying a house, and the reason being is because they can't afford one. I mean, with prices getting out of control and nearly doubling over the last 2 years for every single house, that means that, well, prices are uncontrollable. Now, in 2021, that really wasn't that big of a deal because many Americans were going to still save money because interest rates were really low, but combine really high prices with really high interest rates, now you've got a recipe for disaster. So people have not been buying homes in the United States, and with people buying a lot fewer homes, that means that in some markets we're seeing supply start to grow. And when we have supply growing at a faster rate than demand, that means you're going to have prices coming down. There's just a lot more options out there, and there's not as many bidding wars. In 2021 and in 2020, you had around 10 to 20 people vying for one house. They would all try to outbid the next person by offering a lot more money. You'd see houses going for sometimes $50,000 to $100,000 above asking. And inspection contingencies were getting thrown out the door, and people were buying houses sight unseen. It was an absolutely crazy market. With that crazy market though, everything kind of got inflated. Everything kind of grew at an extremely fast rate. You started to see all your banks and financial institutions hiring a lot of people to kind of meet up with what demand was. Real estate firms also did the exact same thing, but now everything is starting to shrink as there is no demand. There's not enough people buying homes, so these banks cannot support their current infrastructure. And that's why we have some platforms actually predicting that prices are going to continue to come down. Now, the reason that they believe prices are going to come down is because the Federal Reserve is going to continue to raise its interest rates aggressively. Inflation is at around 7.7%, and it has definitely been falling, but 7.7% for inflation is still not a good thing. Remember, inflation is supposed to be at around 2% at most, so we are still 5% above that, and it's going to take some time for the Fed to eliminate a lot of that demand out of our economy by raising their interest rates. So that means into 2023, rates are going to continue to go up, and that means mortgage interest rates are also going to rise. Banks and financial institutions like credit unions get their money from the Federal Reserve. They have an overnight borrowing rate, and that is whatever the Federal Reserve sets it at. Just like you have a borrowing rate of some type of interest rate when you get money from a bank, so does the bank. And if the Fed raises its interest rates, making it harder for the banks to get their money, the bank is going to make it a lot harder for you to get their money by raising interest rates. Prices could ultimately come down because you just have nobody in the housing market and all of these houses for sale. And what you're probably thinking is, well, Nate, if the housing market is losing all of this value, then where is supply? And why is supply not increasing fast enough? I mean, aren't there still people that want to put their house on the market to sell their homes? And the fact of the matter is there just isn't enough people. There is a large majority of Americans that bought houses over the last couple of years. This means they got in at an interest rate of around 2, 3, and 4%. That means that they're not going to want to go sell their house and then get an overinflated price for their new home and a really high interest rate. It just doesn't make financial sense. The big thing that has been going on is equity. Now, equity is the difference between what you owe on your mortgage and what you have already paid off. So you have a certain amount of equity in your home depending on how much your home could sell for. For instance, if your home could sell for $100,000 and you only owe around 40 to 50K on your house, then you have around $50,000 or more in equity. Because the housing market has exploded in price and in value over the last couple of years, many Americans have gotten instant equity in their homes like that. They bought their home, say, at $100,000, and now it's immediately worth $50,000. So they've been paying their mortgage, and now they have $60, $70, $80, maybe even $100,000 in equity in their home. So they're not going to turn around and sell, and the only homes that are coming on the market are for people that have to move, or people that are moving back to the cities, or for people that have passed away. So these houses are coming on the market, but they're not in a mass. They're still at a normal rate. The amount of homes for sale on the market is still 40% lower than where it was pre-pandemic. So there just isn't enough homes on the market, and demand needs to come way, way down, which means mortgage interest rates need to go way back up. Now, here's where things kind of get crazy in the housing market and where things could potentially flip in the future. Many Americans, because interest rates are going up and many people are not buying houses, are losing a lot of that equity. So because prices are coming down in some areas and demand is also falling, that means prices are coming down too. And the value of homes in general is also coming down. So now Americans are losing the equity in that house. That could cause them to not want to sell either, because this is something that happened during the 2007 housing market crash. Many Americans owned their home, and once prices really started to crash and go down, many said, well, I'll just sell my home. But the problem was the new value of their home was less than what they owed on their mortgage. They were underwater on their mortgage. So many of them just decided not to sell, and then they went into foreclosure. Now, I'm not saying this is happening in the United States right now as of yet, but we are seeing that equity come down, and as prices continue to go down, so will the equity that a lot of these homeowners have. So they're going to be forced into a situation where they cannot sell their home. They'll have to go into foreclosure, or they'll just have to continue to make their mortgage payments as is. Many Americans are going to opt to just make their mortgage payments, and they're not going to sell their house. They're just going to ride out this entire situation until it's over, and then when the market kind of stops freaking out, they will decide to sell. So until that happens, we're not going to see a lot of homes come on the market, which means demand is still going to be high, which means prices are still going to remain high in the United States. And with mortgage interest rates suddenly starting to come down, that means more buyers are going to flood the market. They're going to go in because now many more Americans suddenly can afford a mortgage because interest rates just went down by almost a full percentage point. point. That's going to buy up all of the available supply, and again, we're going to have a really hot housing market in the United States. Interest rates going up in the United States is only going to control the demand side, because as interest rates go up, that means fewer people are going to be in the housing market. But as the Fed pulls back those rates, which they will eventually do, that'll make the housing market hot again. So what you have to be careful of and what you have to really pay attention to is foreclosures and people no longer being able to afford their home. Because if you suddenly have a situation where interest rates are extremely high, nobody can buy a home, but then millions of Americans suddenly are unable to afford their home, and now supply floods the market, prices are going to go way down because there's no buyers and all of these homes available. The only thing that could cause that situation to happen is if Americans systematically are unable to afford their home, which means they lose their job or whatever amount of income that they had suddenly disappears. And that's where things kind of can go sideways, because the Federal Reserve raising interest rates means that Americans can't get homes as easily. They can't afford a mortgage because interest rates are going up. But what it also means is that debt in general is going to be hard to come by, like credit card debt and auto loans, and businesses trying to take on loans to grow their business. Investors and businesses are not going to be able to take on loans as the Federal Reserve raises their interest rates because it's too expensive, and they're not going to get a very good return on their money. They might even lose money. So without that investment, now these businesses are going to shrink. And when they start shrinking, they're going to lay off people. We have seen unemployment in the United States hit a record low of around 3.5%, but just last month it went up to 3.7%. And the Federal Reserve anticipates that it might go up even higher to around 4 to 5% by the end of next year. That means millions of jobs are going to be disappearing, and if people don't get new jobs fast enough, their houses are going to go into foreclosure. And the other thing too is inflation, because with inflation still staying really high, well, that means all of the other costs associated with home ownership are also going up, like energy. And if you need to fix something, and of course your taxes and insurance on your house are going to go up every single year. As the value rises, so does everything else. So now Americans have to pay more on top of paying more for their goods and services, which at some point they're going to crack. They're not going to be able to afford all of these things because wages and salaries are not keeping up. Like I said, that could cause a whole slew of Americans to suddenly lose their job or just not be able to. So like I said, this entire situation is pretty funky. It could cause a lot of Americans to lose their job all at once, or many Americans might simply not be able to afford things, so that's going to push them out of homes. Now, what's the likelihood of that happening? Well, we just don't know yet. It really just depends on what the Federal Reserve is going to do with its interest rate policies. And the hope, like I said at the beginning of this video, is that they're going to start slowing down their policies in the future. So yes, we have started to see housing prices go down, and the last thing that you got to keep in mind here is that housing prices have been extremely elevated in the United States over the last couple of years. They've gone up by 20, 30, and 40% in some areas. So when we say they're coming down to where they probably should be realistically. But if you don't have widespread job loss and inflation can come down and the Federal Reserve doesn't raise interest rates too aggressively in 2023, then you're not going to have a housing market crash. What you'll have is just a housing market slowdown, which is not as crazy to think about, but it is a whole lot better for our economy. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.